Hi, this is Linda Eedes, and I'm going to give you an update on the RECM Balanced Fund. Now, the RECM Balanced Fund, which is a Reg 28 Balanced Fund, is positioned very well for this market environment. And what I mean by that is that when you look at what's happening in the market today, it feels very uncomfortable. There's a lot of volatility, there is a lot of movement in prices one day to the next, and that can be very uncomfortable for investors to sit through. The good news is that that means that the market is very inefficient. It's not pricing assets correctly. And we've been saying for quite some time that there is a lot of mispricing in the market. There are a lot of stocks which are priced far too highly, which are great businesses, but unfortunately expectations are too high. And there are many businesses which are actually priced very attractively, but because the market has been very sort of short-term in its thinking, it's not recognizing that the prices are overly pessimistic relative to what's likely to happen through the cycle. So the fund is positioned well for two reasons. Firstly, in terms of the overall asset allocation, the fund has quite a significant position in cash. At the moment, the fund is sitting with about 38% in cash, and that not only provides you with a great tail risk hedge, if you like. In other words, it provides you with a buffer if you have sort of significant market declines, but it also provides you with significant dry powder to deploy into the market as opportunities come about. And it's in this kind of market environment where sort of almost daily you're sort of seeing businesses which have been priced much higher over the last few years coming back significantly and sort of coming back to more attractive territory. So in terms of the overall asset allocation, it's very comfortably positioned because quite a chunk of that fund is actually sitting in cash at the moment. Now remember that that is a byproduct of our bottom-up investment decision making. So it's not sort of a top-down decision to hold a big chunk of cash. It really reflects the fact that we're not finding enough high-quality businesses trading cheaply to actually use up that cash, obviously up to what is allowed within a Reg 28 fund. So that's usually a good thing because it sort of tells you that this market environment has some risks. And that's particularly in terms of the stocks which are trading at too high a price rather than those that have been sort of beaten down. In terms of where we're positioned within the equity space, you'll probably know that RECM has been quite sort of positive on resources and cyclical businesses for quite some time, and that's been to the detriment of investors as we've sat through that weakness. Well, the good news is that year to date, that's actually been a net positive for the fund. In fact, this fund has held its ground during the year to date, where the peer average is actually down 5%, with many other funds performing far worse than that over the year to date. So that's actually been a positive for the fund, and it's very early days, but perhaps the tide is turning. The Basic Materials Index is in fact one of the only indices which is positive year to date in South Africa relative to the other sectors. But the good news about other sectors coming under weakness is the fact that it does provide us with the opportunity to diversify that equity exposure more. And really what's been uncomfortable is that sort of over the last few years, there hasn't really been a diversified set of opportunities for us to take advantage of. But with sort of broad market weakness, that's starting to become more the case. So in other areas outside of resources, we're starting to see opportunities popping up. And that's allowed us to actually diversify into other areas as well. And examples of that would be as the financial sector sold off, we've bought into companies like Nedbank, we've increased our exposure to banks like Standard Bank, and we've also bought companies which have come under some negative pressure lately, such as MTN as well. On the global side, it's also provided us with the opportunity to diversify into other sectors. And so what you're sitting with is a portfolio which still has a compelling opportunity set in the resources space. And there you want to make sure that you're in the high quality resource businesses, the lowest cost producers that can weather the cycle, and the ones that have the best balance sheets. But we also have increasingly exposure to other sectors as well. In addition to, as I say, that nice chunk of cash, which is both a buffer and ammunition to deploy as you see this opportunity set grow. Thank you very much.